Hello there, my name is Amir Azahar, and I hope our previous tutorials have been useful to you thus far. Today, I will be guiding you through an introduction to options and futures. Options and futures are the most dangerous financial products for beginners to invest in. Both options and futures make use of the adverse market movement, which allows, or requires, depending on how you look at it, the investor to hedge against the price of your securities and make profit from it. Hence, investing in options and futures contracts is akin to playing with fire, and investors must be aware of the potential of burning their hands, so to speak, with huge losses if they invest in them. Now, let's take a look at the options. Or rather, let's take a look at options. Options are a contract agreement that allow a buyer the right to buy a set amount of an asset at an agreed price, and the seller is obligated to deliver them. This can also operate in the reverse, where a seller has the right to sell an asset at an agreed price, and the buyer is obligated to buy. Options are contracts that are created or cleared through an exchange compared to futures contracts which are cleared to both parties. There are two types of options: a call option and the put option. Both of the options are discussed below. Call options are options used by investors who are buying the asset at the exercise price. The seller of the call option is required to deliver the asset as the buyer of the call option when the buyer of the call option exercises his right. Put options allow investors to sell the asset at the exercise price. The seller of the put option is required to deliver and pays the exercise price if the buyer demands it, or if the buyer exercises it. Futures are contracts where two parties that agree on a specific term of the asset class, where the buyer agrees to pay a specific price on a future date, and the seller agrees on delivering the assets on that date and receive the money based on the agreed price. There are different terms for futures that are called long, short, open, and close futures. Long futures are employed by the buyers, which are used to buy the asset agreed in the contract at a specific price in the future's date. This is used by investors who feel that the specific market asset price is bullish. Or in other words, is bullish regarding the current state of the market assets prices. Short futures are used by the sellers to deliver the asset on the date on the contract on the agreed price. The investors may use this term as the investor of the same contract feels bearish on the market asset price. Open is the term used for traders for the initial trade of the futures contract. Close is the term used by investors for when the futures contract has been closed, so to speak, and the asset in amount has been delivered. There are a couple of risks that investors have to take note of before they invest in options and futures. The first risk is complexity risk. Options are not recommended for beginners as they are very complicated. It is difficult to understand how options are traded and requires great observation and maintenance. Investors of options must have the skills of analyzing the market so that they can look out for opportunities to buy the options and execute them before they expire. Options can sometimes be more expensive than investing in underlying stocks. Trading futures contracts is also not recommended for beginners. Besides the potential for huge losses, the contracts themselves are rather complicated. Futures contracts are usually traded in different sizes and price movements amounts. For example, a corn contract is 5,000 bushels and one tick is worth $12.50. This means that buying a corn contract will cost 5,000 times $12.5, which equals to $62,500. Also, investors must keep their attention on all up-to-date news that could affect the price of the futures contracts and make analyses according to their findings. The next risk to note is counterparty risk. there is a possibility that the seller defaults and is not willing to sell or buy the underlying assets as agreed. The only way to reduce the risk is to find a counterparty that is trustworthy and does not have any default history. Lastly, investors make a margin deposit of 5 to 10% of the contract value to buy or sell futures contracts. The leverage ratio of futures contracts is 10 to 1 to 20 to 1, and if the investor picks the wrong contract, the investor will lose a huge proportion of or all of the margin deposit very quickly. Investors must be able to monitor the price of the futures and make it necessary to move to limit their losses. We have come to the end of our third tutorial. I hope you have a better understanding of options and futures, and stay tuned for our next tutorial where I will be covering mutual funds and other products. Have a nice day.